last 8 to 12 weeks has been that the banks have reduced their short exposure to COMEX, to being net short COMEX gold and silver futures. So, I mean, you're looking for some indicators that, we may be bottomed from, this painful sell-off that we've had that's mostly affected the mining stocks, not so much the metals.
Welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter and the CEO of the Soar Financial Group. Really appreciate you joining us here for this discussion, because today it's going to be very gold and silver focused. We're not just going to talk macro. I really want to know what is driving prices these days, because as we're recording this, gold just jumped over $2,000. Again, of course, but this is like the fourth time it's doing this in a very short time frame. And I want to know what is driving prices right now. Is it geopolitics? Is it a looming recession? Is it a looming market crash? What is it? Or is it just positive sentiment? I don't know. It's like we're always doom and gloom here. Maybe there's a positive factor driving gold. We're going to find out from Dave Kranzler. He's the founder editor over at Investment Research Dynamics, also publisher of the Mining Stock Journal and the Short Sellers Report, or Short Sellers Journal as well. Really looking forward to this discussion. Let me bring Dave on the program. Dave, it's good to see you again. Wonderful. Good morning to you.
Likewise, Kai. Good to see you.
Yeah.
Good early morning in Denver.
I was going to say, is it the gold price that woke you up? Because it's 7 a.m. where you are right now, and gold just jumped over $2,000. Did that get the blood going here?
Yeah, I was. I was kind of watching it last night before I went to bed, and it was perking up. It was perky. And it didn't. So typically what happens is that the overnight pattern is it'll rally during the Asian trading hours or Eastern Hemisphere. And those are what I call the true physical bullion trading markets. And then what happens is once Asia closes down around 3 a.m. New York time, it'll start to sell off. And if it doesn't sell off by then, they not always, but the majority of the time they bang it down in going into the London AM price fix. And then it kind of bounces around, and then it gets hit again when the COMEX opens, which is 8:20 New York time. So, and I just happened to notice it did.
There is a bit of a smackdown if I'm looking at the daily chart here, yeah.
Closed, but then it had a little bit of a bounce into the AM fix, and then obviously it's spiked up again at the COMEX open. So that to me probably indicates there's some short covering going on in London. And that I'm talking about derivatives short covering, right? LBMA forwards and COMEX futures. So it kind of tells me there might be some short covering going on, which is over not the last couple commitment of traders reports, which have shown, well, actually silver that the banks got more short, but I think it was gold where they were covering, or it might have been, I forget, one or the other. But in general, the pattern over the last 8 to 12 weeks has been that the banks have reduced their short exposure to COMEX, to being net short COMEX gold and silver futures. So, I mean, you're looking for some indicators that, we may be bottomed from, this painful sell-off that we've had that's mostly affected the mining stocks, not so much the metals, and we could be heading higher.
Let's talk gold and silver prices in particular in a minute. I really want to zoom out real quick and spend the next 5 to 10 minutes just on the general state of the economy and what your thoughts are where we're at, because I really want to work out, like, okay, what is driving prices? I have a hard time explaining it just with short covering, because there seems to be a lot more going on.
Oh, I agree.
Right?
Yeah, no,
so
I agree.
Let's see if we can work that out a little bit, right?
Yeah.
Dave, in your opinion, like how are we doing? How is the economy doing? It seems very fragile right now, in my opinion. What are your thoughts?
I mean, it depends on who you listen to. If you listen to Wall Street economists, you listen to the Fed, you listen to, Washington, D.C., everything's hunky-dory. Unemployment's low, right? The market for labor is strong, which is BS. But, inflation, it sounds like they're reining that in, not. So, in terms of how information is communicated, we've obviously kind of gone into a bifurcated world. There's the faux reality that politicians and governments and economists, mainstream economists, want us to believe, and then there's the real world, the grassroots level Main Street world. And it's what's happening in the real world is the opposite of what they're trying to sell us with their propaganda. So, and I say this, I scour hard economic data every week for my short sellers journal. And by hard economic data, I'm not talking about, the highly massaged, rigged, politicized government reports, CPI, labor report, and GDP, but like, grassroots Main Street data. What are corporations saying? What are privately compiled data series showing me? You know what I mean? So, I mean, there's a all out near depression going on in logistics and freight transportation, the freight transportation sector, right? And that's the same thing going on in the manufacturing sector. Some of the regional Fed economic indices have been negative have been declining or negative since early to the middle of 2022. The leading economic indicators were just released yesterday, and they've been declining for 19 months in a row. Now that tells you that the manufacturing sector is in a recession. We've seen what's happened in the housing market, and this pretty much applies globally, but I zero in on the U.S. But China's having a hard time. They've got a commercial real estate disaster brewing, just like the U.S. does. The commercial real estate sector is much worse than we're being led to believe in the financial press. I've got one of my best friends who I worked with when I was a bond trader in New York, and he's a wealth advisor now. He was at some type of holiday party or conference or something earlier this week. I think it was, today's Tuesday, so I think might have even been but anyway, that's neither here nor there. He was chatting with a guy who is like a commercial real estate titan in the Northeast. And they were at the top of some building, presumably one of the ones that he built. And they were looking, he just started chatting with him. And this guy was pointing out various buildings that he said, you see that one? That one originally sold for like $225 a foot. It's about ready to trade again for $85 a foot. So, I mean, that's distress level for commercial real estate. And whoever had the mortgage on that building is going to take a hard hit. And that's multiplied across big cities across the country. So, and this guy, he's actually going to retire. And he said, if this ever does recover, it's going to take a long time because, the era of easy Fed money, 0% interest rates, that stimulated too much building in the commercial real estate sector. It stimulated too much building, period. So at any rate, I think technically, if the GDP were measured correctly, it would show that this country has been in an economic contraction for the better part of probably 18 months.
Dave, are you surprised that WeWork's bankruptcy hasn't made more headlines? I'm surprised like how it came and disappeared. It was a one-day headline, and I think that's a big indicator.
If you remember when it first ran into trouble, when it first hit the wall, it was getting a lot of news. I'm sure the mainstream financial media has been told to dumb it down on the reporting of any of this stuff, not just WeWork.
Yeah, it's interesting. Commercial real estate, of course, might be the straw that breaks the camel's back here, right?
I think there's several proverbial straws that are gonna kill the camel.
Yeah.
Not just break its back,
but
kill it.
for our conversation, let's focus on the straws just for the topic of discussion here. Is like really what is driving the gold and silver prices, because I think some of those straws are directly influencing the precious metals. What would some of those be? Like maybe just a talking point to your the bond market.
Well, I mean, just generally, I mean, it isn't just commercial real estate, it's every level of the economy has a record level of debt, and it just keeps getting worse. And again, that was fostered by so-called quantitative easing. It's money printing, just it's just an Orwellian term for money printing, and ZIRP, zero interest rate policy, and that stimulated the overusage of debt, and it's everywhere, household level, state and local government level, federal government level, and corporations. I mean, they all have record levels of debt, and at some point, the ability to sustain and service that debt becomes untenable, and you start having defaults. We're already seeing the default rate kick up. Actually, with subprime auto loan debts, the default rate, or the delinquency rate, 60-day delinquency rate, is at an all-time high. It's like 9%, and that the default rates will follow from that. The banks, it's not just commercial real estate that regional banks are going to choke on. A lot of local and regional banks are the ones who were aggressively extending subprime car loans, right? And they're going to choke on that debt. We're starting to see the delinquency rate in mortgages kick up, right? And it's still low relative to where it was in 2008, 2009. But I mean, the trend has turned up, and it's going to get worse. I mean, despite what the BLS says, the real true unemployment rate is much higher than what they're representing. And you just need to go to John Williams shadowstats.com, and he's got, he measures all of these government statistics the way they were measured historically, right? Before, starting when they started, messing with how they do the calculus on the report, CPI, GDP, employment. And he's got the real unemployment rate, is much higher than what they're saying. I'm talking like 3 or 4 times higher. So, and if you break down like the labor report, a lot of these so-called jobs are the same people taking multiple part-time jobs to make ends meet, and the full-time jobs, full-time paying jobs, have actually been declining, and that it should be. It's reflective of what I'm seeing in the hard economic data that comes from the private sector. So, that's one of the things that's really important to do is when the government releases a BS report, or even the National Association of Realtors, their monthly existing home sales report it's seasonally adjusted, and it's an annualized rate. So any of the statistical flaws in a given month become magnified because they annualize that number as if that's the 12-month run rate for that month, right? But so if you just look at the data that's private sector data, I mean, NAR is really a trade association, I guess, but so in some sense it's private, but it's often referred to as quasi-public. If you look at some of the correlative data series like mortgage applications, that doesn't fit with the data that we get in the new new home sales or the existing home sales report. It's reflective of a much worse situation than is being reflected in the NAR home sales report, or it's the Census Bureau that puts out the new home sales report, and that thing is always wildly inaccurate, and it's always revised downward in later months, right? Why not do it that way? Because no one cares about what the downward revisions. All they care about is the current headline number.
No. Dave, like a lot of cracks in the system. You mentioned the depression in logistics and freight, housing market, commercial real estate. What's the glue that's holding everything together? Because we're looking at these data points, these indicators, and like we make rhyme and reason out of it. It's like, okay, guys, this is not sustainable. What is happening here? But apparently, Wall Street, or Main Street, even to a degree, is ignoring those facts. Like, what is that glue, or what is the the drug that makes people hallucinate and forget reality, for a lack of a better acronym synonym here, or a metaphor. What is that? Is that cheap money? Because that I don't think there's a lot of cheap money out there anymore. Is it still that SERP left over, or the student loan forgiveness, or the Inflation Act, the CHIPS Act, like a lot of money programs? But like, what is that glue? What's that magical drug that makes everybody forget and not look at the facts?
Sure. I mean, that's a good question. I'm not sure that it's being held together per se. I guess it's
But
just
you
a
know what
matter
I
of
mean, right?
semantics.
Like, what is?
There's beneath the surface, there's fissures and cracks, and they're getting wider and wider. Again, it's just, you know, the way our system operates now, if something's not reported in the mainstream media, then it can't be a fact. It can't be true, right? And so you don't see a lot of the hardships that get reported. I mean, if you know where to look for it, you can find it. There was just a report out this morning. Fidelity Investments said that they've got the number of people taking out hardship loans from their 401ks or taking loans against their 401ks is like double what it was a year ago. And these people are taking this money out to make ends meet on a monthly basis. Same with credit card debt usage. But I mean, in terms of the glue holding it together, I mean, from 2008 to now, basically, it was all the money printing. And in fact, you can take it further back than that. I mean, you can take it back to really probably the early 90s. If you recall, there was a big real estate bust back then connected to the junk bond market and the savings and loan crisis. And then you had the dot-com bubble burst. And in both those periods of time, Greenspan put his accelerator on the money printing, on the, not necessarily, they didn't call it QE back then, but he was making liquidity available to the banking system. So, and that's, even though the Fed says that they're doing quantitative tightening, whenever there's a forest fire that erupts, that ignites, it prints money or makes credit facilities available to put it out. We saw that with the regional bank crisis, right? Immediately they made 400 billion. They injected 400 billion directly into the banking system. I mean, their balance sheet spiked up by 400 billion, even though they're supposed to be reducing it. But they also, and this one isn't getting as much attention as that did back in March, but this bank term funding program, and I've gone to the Fed website and I've reread a couple times how the facility operates. I don't think they've put a cap on how big it can get. Now they put a maturity on it in March 2024, but that facility is for banks to tap into when they have liquidity issues, presumably to fund deposit outflows so that they don't have to sell their hold to maturity securities at a big loss. Because if they had to do that would cause a big problem in the banking system. So this facility, it's up to about 113 billion, but it gets bigger every month. And the ironic thing about that is that if you look at the data, I was just looking at it last week, deposit outflows, the regional banks that this facility was originally supposed to target, their deposits, they've actually been getting inflows. And the reason is because they've raised the interest rate that they're paying on it to almost what you can get in a money market fund, because that's what happened to a lot of that money. I did the same thing, pull money out of the bank or out of a brokerage account, and I bought T-bills because I get 5% on a T-bill. Why wouldn't you do that? You get 5% on a money market fund. So the regional banks raised their interest rate, and now they're getting deposits back in, but yet the facility is still being tapped. And I think that's coming from I think it's the Fed won't tell you who taps into the facility on a weekly basis, but my guess is because the large banks are still seeing deposit outflows. And part of that reason is they haven't raised the rate that they're paying on demand deposits up to a level that can compete with money market funds and T-bills. And so I wouldn't be surprised if it's actually the large banks that are starting to tap into that thing. Now, all that being said, that's part of the glue that's holding this together, because it still provided a significant amount of liquidity for the banking system. They just don't call it QE. Now we'll find out in March what happens with that facility, because if it keeps going up, that's telling you that the banks that have already drawn from it can't pay back what they've drawn. And if you remember in 2019 in September, the Fed started a temporary small repo program, to clean out the experts were referring to it as, well, we need to clean out the pipes in the plumbing system of the financial system. Like, that's bullshit. The banks are there. You could see the liquidity crisis coming from the banks if you looked at the right data starting in August that year. And if you remember, that repo program got bigger, and the term got extended from overnight to 2 weeks to, they had some terms out beyond a month, I believe. And that kept getting bigger and bigger and bigger until the COVID crisis. And and the COVID crisis gave the Fed cover to inject $3 trillion into, if you remember, $3 trillion into the banking system under the guise of saving the economy. It was really to save the banks, because that's probably what the banks needed to reliquefy the banking system. And again, it's the same, it's debt that isn't being serviced by the debtors. And when that happens, and also bad investments by the banks, derivatives obligations. How come with all the volatility we've seen in interest rates and the stock market, how come we haven't heard about any big hedge fund or bank blowups from derivatives? Because the central banks, and it's not just the Fed, the central banks are kind of they learned from 2008, they're kind of making sure that if they can see something coming, they make a credit facility available to reliquefy it. You see what I'm saying? And that, again, it's not reported as money printing, but it's de facto money printing, right? Because when you take out debt and you spend that money, that's the same thing as printed money until you have to pay it back, right? It's just called credit. It's not called currency or digital currency.
Just call it differently.
So that's basically your glue that's holding everything together. I think it's getting harder and harder for them to do it. We're seeing that with the volatility in the bond market. I mean, the markets themselves are, even though the VIX is low, I mean, the volatility and the intraday volatility is huge if you watch it trade every day. Huge I mean, look how quickly the 10-year went from pushing 5% down to, I think it bottomed at 440 last week. And I think it's headed back up to 5%. I mean, the volatility is just incredible.
Yeah, because we're getting reports
now. It might have been lower than 440. So and it happened like that, like within a couple days.
Yeah. Well, we're getting reports that the bond issuance, the Treasury bill issuance, is not getting fully bought up anymore. That the market is not acquiring all the bills that are being issued anymore.
I don't know about the T-bills. I did notice the Fed bought some T-bills. I think it was yesterday there was an auction, and I think part of that is their balance sheet management. But they for sure bought over, and it doesn't sound like a lot, but in the context, the 30-year auction last week, they bought over 400 million of it, and that they had to get it over the finish line. And again, if you think about how the bond auctions work, so money market, the reason why they've been issuing massive amounts of T-bills to fund the spending deficit is because money market funds have been flush with cash. Money market funds are the majority of the reverse repo facility, right? And that thing peaked at, this is off the top of my head, so don't hold me to it. I think at the end of 2022, it peaked at something like 2.6 trillion. And it often spikes up at the end of a year, calendar year. It's bank balance sheet manipulation, essentially. But at any rate, so that thing, and I didn't check where it was yesterday, but it dipped down to under $1 trillion. And that's money market funds pulling their money out of that and funding T-bills, right? They'd rather, to manage a money market fund, you can invest, I think, up to 12 months. And you'd rather just put the money to work for 3 months or 6 months or whatever, rather than just to keep having to do the reverse repo transaction. So it's the cash that's in the money market funds that has been funding the government spending deficit. The banks themselves, the big banks, the primary dealers, those are the ones that they to be a primary dealer, you have to participate in the Treasury auctions, right? Because that's how it gets transferred from the Treasury issuing it to the banks and then resold out to investors. And the paper that banks they don't have, if there's not enough demand from institutions and foreign investors and the public, the banks have to sit on, part of what they bid on at the Treasury auction. And so when the Fed has to go in, step in, I mean, there's no freaking reason in the world the Fed should be buying the long bond. And when the Fed has to go in there and buy it, it tells me the Fed had to participate in order to get that deal over the finish line without seeing rates really jack up to a level that would attract enough money to buy the 30-year bond. I mean, I don't know, unless there's, some stupid asset management reason, like a pension fund or something, why they need to have long duration paper in their portfolio. I mean, why would you buy a 30-year bond at 457 when you can buy a 3-month T-bill at 541 and just keep rolling it over, right?
Exactly.
Yeah. So I guess my point here is that it's a long-winded way of saying, that's another sign that the big banks are getting squeezed from a liquidity standpoint. And again, as long as the Fed keeps putting out liquidity facilities and people don't interpret that as being quantitative easing or money printing, that's the glue that holds it together. But at some point, you're gonna, the system's just gonna implode under its own weight.
I love the term liquidity facility. Right?
Yeah.
Instead of QE. Fantastic. Real quick, while you were chatting, I was looking up the Fidelity Report, and the National Association of Plan Advisors is quoting from it. I just found their website. And one thing they're saying is that juggling the short term has become a persistent problem, as Fidelity research shows. 8 in 10 Americans say inflation and the cost of living are causing stress, with most adults, 57%, unable to afford even a $1,000 emergency expense. That's crazy. Like 8 out of 10, that's 80% of the people are starting to suffer and starting to feel the pains of inflation and economic stress. That's crazy.
Well, that 57%, because I saw that number this morning also when I read the report, that before the pandemic crisis and all of the money that the government distributed, basically helicopter money. Pre-pandemic, that number was more like 78%, and that was a number that was at least in the alternative media was discussed. The fact that surveys were showing that up to 78% of households didn't have enough cash on hand to deal with a $500 emergency, and then that the helicopter money and the moratorium on student loan payments. If you remember, there was a moratorium for people on mortgage payments. Not everyone qualified for it, and so those moratoriums have been lifted, and it's starting to cause stress. So, and that gets back to there's another part of, or another type of glue holding the system together, and that's government spending. And the government's record level of debt every day. So that just means they're spending a record level, but the deficit spending is at a record level on a daily basis. Part of that's defense, but it's also other types of programs that they're using to try and stimulate the economy.
Yeah. Dave, let's circle back to the gold price and silver price. What is propping up gold prices these days? Like, what are the main drivers? You mentioned short selling as one of the reasons, but that's more of a short-term effect, I think. What is driving gold prices longer term? What have you made out as some of the main drivers these days?
It's up $5 since we started chatting, so maybe we should just keep chatting all day.
There we go. We should have done this live.
But if I wanted to fall back on Occam's razor, I would just say more buyers than sellers, right?
Duh.
But why are there more buyers than sellers? That's what you're asking.
No, exactly. Like, what has changed? Like, because we've been, gold dipped down to 1810 early in October. Of course, we had a bit of a geopolitical issue, which still has been resolved, but it seems like there's a solution, somewhat of a solution, achievable here in the near term. That's what I've been hearing in German media this morning, that Israel and Hamas are at the table working on a deal. We'll see where that goes. So for me, geopolitical tension is less of a factor. We've seen gold dip actually last week back to 1930. So some of the, let's call it the geopolitical air in the balloon has been left out. What are some of the other factors maybe you've been looking at?
I mean, for sure, the geopolitical variable is part of the equation, but I mean, unless everything's going to escalate into nuclear, and we're not going to need gold and silver anyway, right? We'll need ashtrays. At some point, the geopolitical element it dissipates, right? It dies down. I mean, Ukraine doesn't affect the markets at all anymore. So, and obviously, what's going on in the Middle East gave gold a goose, but it's also, I mean, what's interesting to me, and I actually wrote about this in my newsletter, is that it feels like the precious metal sector is struggling, right? It feels like it's, prices keep going down, they're not going up. But if you look at gold, just look at I've got a 3-year daily chart up. I mean, it got as low as 1620 back in September 2022, but then it bounced right back up to 2080. And so it's kind of been in a 3-year lateral trading channel, right? And the price management team doesn't want it to go above 2100, and they've been able to maintain that successfully since August of 2020. But it hasn't. I mean, if you cut out the two sharpest spike downs in that 3-year period, really it's been holding at 1800. So silver probably looks somewhat similar. We'll just keep it with gold, just keep it simple. It's the mining stocks that are giving people agitation, including me, because if you look at, so I've got shoot, Fidelity system froze up on me. If you look at a 3-year chart of, and just use GDX, let me bring that up here. Sorry about this. I mean, if you look at a 3-year chart of GDX, you get the full effect here. So GDX peaked back in August 2020, and I remember that pretty vividly because it ran up really quickly. And when the Fed dumped $3 trillion into the system, as did all the markets, and then it started into a long-term downtrend that's been punctuated with two pretty sharp rallies. And so, but if you look at it now, it looks like it may be bottoming. And if you just look at like a 1-year chart, I mean, it looks like it could explode higher. I've got a 1-year chart in front of me, and I know technical traders would say it's either a bull flag, or they might say it's what do they call it, a triangle or something that'll resolve either way. But I mean, if you circle back to the fundamental variables, geopolitical, out of control government spending, out of control government debt levels. People, there's no way inflation's coming down, especially if you use a real gauge to measure inflation. So let's just throw the CPI out. What people, everyone focuses on what the Fed's doing, right? What about what's the government doing? All this government debt that devalues the dollar. It's devaluative, and real interest rates are still negative. When I say real interest rates, I'm not looking at the standard measure that looks at inflation adjusted securities, right? Because those are flawed by nature, because the interest rate that they pay is based on the CPI, right? So if the CPI is flawed, then using TIPS as a measure of inflation or expected inflation, that's flawed, because it's got flawed inputs. So again, if you use the shadowstatistics.com, John Williams measure of inflation, and all he does is he he takes the data that goes into the CPI and he calculates it using the way they calculated it in 1980, and he uses that because that's about when they started monkeying with how they calculated the. I mean, look at the latest report. 34% year-over-year decline in health insurance premiums. Well, the reason is they decided to change how they measure health insurance premiums, and instead of actually surveying health insurance companies and asking them what they're charging and comparing it to the past, they're using the retained earnings of healthcare companies, which is just absurd. Because that, while net income at these insurance companies may somewhat reflect what they're charging for healthcare premiums, it's just, it blows my mind that they actually think that that's the way to measure healthcare premiums. I've got a long-term subscriber to both my newsletters, and when the number came out, he said, I sell group policies to large companies. He goes, I can assure you premiums aren't down anywhere near 34%. They're not down at all. So if you use a real inflation gauge, real interest rates are still negative. And that's like nitroglycerin for gold. And the reason why gold hasn't been going up is because, the price management squad, the Western central banks, have been so far successful at keeping a lid on the price of gold, but they haven't been able to drive it lower, right? For 3 years, they really haven't been able to drive it lower because we're at the same level where we were 3 years ago. And so that tells you that I think what the influence is that's keeping it, from keeping them from being able to push it down further with derivatives is all the physical demand coming from the Eastern Hemisphere. And again, that's something that gets overlooked by everyone except, the gold bug community and the people who write about it and track the data. But, China, well, central banks collectively, and when you see that reported in the mainstream media, they just refer to central banks. Well, the Western central banks aren't accumulating physical gold, right? It's the Eastern Hemisphere banks. It's China. Russia started buying again about a year ago. India imported a massive amount of gold last month, and they also imported a massive amount of silver. And all of the smaller Eastern Hemisphere bloc countries, their central banks have been accumulating gold. Even Poland, which kind of surprised me because Poland is kind of a lapdog for NATO and the US, and their central bank started buying gold again. And not only are they buying it, they're having it repatriated from London to Poland. Because, if you really understand how London works, you wouldn't trust the vaults in London, you wouldn't trust the vaults in New York. So the OPEC countries are accumulating gold. Dubai is now I think it's the second largest gold hub in the world after the Shanghai Gold Exchange. So that it's really, I think the physical demand is pushing the price from below the big web of derivatives that's sitting on top of the physical market trying to hold it down. Does that make sense?
Yeah. Oh, absolutely. Dave, last 5 minutes, I just quickly want to talk about the mining stocks as well, because I'll share my instincts with you. But it seems like we're bottoming, and a lot of the stocks have bottomed and are actually there's a trend change, it seems like. And I'm curious if you're seeing the same. I know we're in the middle of tax loss selling here still, in that middle of tax loss selling season. I might be wrong, but I've looked at quite a few charts over the last few days here, and I do see jumps by 10, 15, even 20% from that bottom. We're still way undersold, of course, or oversold in so many stocks. But what are you looking at when you look at the Mining Stock Journal? Like, what are you recommending? What are you seeing? What are some of the trends in the mining stocks?
Sure. Well, my primary focus in my newsletter is the junior project development companies, the micro caps, because when and if we get the move that I think is coming, that a lot of us think is coming, those are the stocks that'll outperform the most. But I also feature several mid-cap producers. I don't really care about Newmont and Barrick. I don't think they're well-run companies. And if if you want a safer, a less risky mining stock, I think the mid caps like a Fortuna Silver or Hecla. There's one that I picked up coverage of about 9 months ago, I guess. Caliber Gold. if you're familiar with that one.
They just made a
Algo
massive
Mining is
acquisition.
really the official name. And that one is ridiculously undervalued. And they just made a great acquisition in Newfoundland, Marathon Gold. And the market, I don't think really, I think part of what the market is freaked out about with Caliber is that they the bulk of their revenues comes from Nicaragua, but it's misunderstanding the nature of the political risk there. Yeah, there's political risk. There's political risk in every jurisdiction. Nevada has political risk, right? If you talk to mining company CEOs, in a lot of U.S. jurisdictions, it's a nightmare trying to get permits, the environmental permits, and it takes a long time. Not so much Nevada per se, but some of the other states where there's mining. California, I won't touch California. Any company that's operating in California, I won't even look at it. Yeah, I'm seeing the same thing you are with the charts. I started noticing it, I don't know, probably 4 to 6 weeks ago. And if you just pull up a handful of the micro cap juniors, like a Cabral Gold or Silver Viper or a Viva Gold, something like that, and you look at a 1 year daily, you can see now the micro cap juniors just got obliterated relative to the mid caps and the large caps, relative to GDX, just obliterated up until maybe the fall of 2022, or maybe early this year. And then you see they kind of stop going down, and they've been kind of going, they've been forming a long base in their charts. And to me, I don't know how much more downside, if you pick a good company that has a valid project, and it's trading at 8 cents, how much downside does it have from there? Probably not a lot. It's not going to go to zero. Because even if it becomes distressed, some strategic company, will make a strategic acquisition just to get the resource that's in the ground. So I started accumulating these junior microcaps, a few months ago. Even some of them even longer than that, just because it's like, okay, the downside's limited and the upside is 5x or 10x. But now, in terms of whether we have a trend change, I want to see a little more of a sustained upturn. Like if I'm looking at a chart of GDX, and you can see that it looks like it's trying to bottom here. And even though, again, I'm just looking, it's been in a 3-year downtrend, and you can even see it on the 1 year chart. It's been in a down, from the last rally we had, it's been in a downtrend since the end of April, early May this year. But it looks like it's trying to come out of that. It looks like it may have bottomed. And I'd just like to see it. I mean, really what I'd like to see it is get into the high 30s and hold and move higher from there. But, if you've got some speculative capital and you want to bet that we've bottomed and are headed higher for all the reasons we talked about, why this sector should be going higher, now's probably a good time to start wading back into the sector. And if you look at, this is another thing, if you look at and you can just run like GDX or GDXJ versus the price of gold. And I have a chart where I take it back to 2001, because that's when the secular bull market started in the precious metal sector. The mining stocks have badly underperformed the price of gold, but you can also see the same thing if you run it versus the S&P. And they haven't underperformed the S&P over the whole time period, but say over the last 10 years, they've badly underperformed the S&P. And at some point, you're going to start to see so-called value investors, big mutual funds that are value oriented, and they're going to start buying these stocks. And that's a lot of capital that could flood into the sector. And we saw the same thing back in 2008. I mean, I remember T. Rowe Price and Fidelity, in not just their dedicated gold funds, but in their macro funds, started taking big positions. Not so much, they're not going to buy the juniors, although Fidelity did take big positions in some of the juniors. But they're going to buy the mid caps and the large caps, the more liquid names. And it's not like they're writing them for, the next, quick rally higher, the next, where they're driven by speculative frenzy. They're riding them because they see, 300, 400% gains down the road in these things.
Absolutely. Dave, wonderful insights. I need to get you back early January for a bit of a market outlook and where do you see things heading in 2024. We haven't even talked about the US presidential elections and sort of the impact from that.
No.
So, if any, but we'll need to catch up on that because 2024 could be quite interesting in that regard. Dave, where can we find more of you? Fantastic content. Where do we find more of you?
Sure. And by the way, thanks for having me on. I always love talking to you. You just you steer a conversation, you construct a podcast really well in
Thank
terms
you.
of
Appreciate it.
topics. So my website is investmentresearchdynamics.com, and there's links at the top of that if you want more information on my newsletters. And then I'm also probably considered abrasive and obnoxious, but I'm also on pretty active on Twitter or
Fantastic.
X or whatever we're supposed to call the thing now.
Awesome. I think Invest Dynamics is the handle, I think.
Yes, or you can just search under Dave Kranzler and find me.
Fantastic. Awesome. Dave, thank you so much for your time. It's really, really appreciated, especially at 7 a.m. in the morning when we started hitting record here. So early. But
Again,
at a
thanks for having me on.
$2,000 gold price, I'd get up early too, Dave. So fantastic. Thanks so much, everybody else. Thank you so much for tuning in. We hope you enjoyed this conversation with Dave Kranzler. Make sure to follow him on Twitter and, of course, visit the website investmentresearchdynamics.com. If you haven't done so, make sure to subscribe to our channel as well. We're putting up a lot of good content to help us understand the micro, meaning what is happening in the world of gold and silver, but also with the mining stocks. Oftentimes we discuss the macro at length just to understand what is going on because so many factors are directly affecting our precious metals. Thank you so much for tuning in. We'll be back with lots more. Thank you.